So as far as the equity markets is concerned, our strategists are effectively saying that what this rise in yields is going to do is to cap the valuations of the equity markets, and that you should look for more presence in the cyclical sectors. And on the dollar, our strategists are really saying that it's going to be more stable. There are two countervailing forces. One is that the rates are rising and the yields on the US currency is rising. But on the other side, we are also quite bullish on global growth. And when you have that reflationary environment, that's sort of a factor that drags the dollar down. So all in all, we are looking for a more stable dollar going ahead.
And if we are talking about a reflationary environment, then how does the emerging world, how do emerging markets deal with that or cope with that?
So emerging markets should continue to do well. Look, the rate rise that we are seeing in this cycle or are going to see in this cycle is going to be very similar to what you saw in 2003 to 7. So if you look up the trend for 10-year real rates or 5-year real rates, they were rising. But at the same time, because the Fed was lagged, you saw current account deficit in the US widening that was supporting the emerging markets external environment. And we think something similar is happening right now. The US current account deficit has started to widen. The Fed, as we know, is consciously taking a decision to be slow and gradual. And so you will see further boost to Asian exports and emerging markets exports that will help them. At the same time, to the extent to which the Fed is not taking real interest rates aggressively, quickly into positive territory, that should also provide some comfort to emerging market central banks in not having to take up any kind of pro-cyclical tightening. So both these factors, better external demand as well as low real rates in the US, should help emerging markets. And so we are quite constructive on emerging markets growth outlook.
Right. But Chetan, final question. If the Fed is thinking about tapering, or if Morgan Stanley believes that the Fed could get to that point by Jan 2022, when do EMs follow, or is it really going to be each EM for itself?
Well, I think it depends upon EM's conditions in terms of macroeconomic environment. We think that EMs will actually be taking up rate hikes in this calendar year itself. We're expecting in the next 9 months for about 6 central banks to start hiking interest rates. And that is because their own growth fundamentals and inflation outlook will warrant them to take up rate hikes. So they would be already in a position where they would be tightening their monetary policy. At the same time, EM's macroeconomic fundamentals in terms of current account and inflation is in a pretty good state right now. So we think when the US rate rise is continuing to go on in the next 12 months, as long as it is not disruptive like what we saw on that Thursday last week, and it is gradual, it should be fine for emerging markets, and they should be able to continue with their growth environment, which is, we think, going to be constructive for them.